The markets are going absolutely bonkers right now, and I'm sure you understand why. It's because Donald J. Trump has just been elected the 47th president of the United States. Now, that being said, today we're going to be discussing, in particular, the DXY, the dollar index, which illustrates how much the dollar is worth in comparison to other currencies. The reason why I believe it's important that we discuss this now is because with cryptocurrencies rising, with the stock indices, the S&P 500, the Dow Jones, the NASDAQ rising like crazy, I don't believe this is going to get enough coverage. But I also believe that it needs more because it showcases not only how traders and people with big money are viewing Trump's presidency, the policies he's going to enact and what that's going to do for the economy, but also what it could mean for risk assets moving into the future and why I believe it may catch a lot of people off guard. Now, with that being said, if you're new to this channel, my name is Nathaniel Knuckle. Here, I like to discuss politics, geopolitics, markets, investing, finance, all of the things that get wrapped up into one cool, cozy package, a beautiful yet ugly package, a fascinating package, an entertaining package. And if you like that sort of content, subscribe to the page. And with no further ado, let's dive right in. DXY, U.S. dollar index soars to a 4-month high as Trump victory boosts greenback demand. Markets flock to the greenback in anticipation of Trump's pro-growth, pro-U.S. policies, sending it to a 4-month high against 6 Forex rivals. The U.S. dollar index, DXY, pumped to levels above 105 after Donald Trump was declared the winner of the 47th presidential election in the U.S. The former and future president's agenda is packed with domestic policies which boost dollar demand, leading to the index's 2% rise on the day. The gauge, measuring the dollar's valuation against 6 major Forex currencies, hit a 4-month high. The outlook is certainly looking bright for the buck. Trump has vowed to introduce tariffs on trading partners, which is seen as bullish for the dollar, even as this move may strain some of the international relations of the U.S. with major countries. Domestically, Trump has pledged to support small and mid-sized businesses and concentrate his efforts on hiring U.S. citizens and stimulating homegrown companies. All that bodes well for the U.S. dollar. Still, other factors are in play, and a big one is coming later on Thursday. The Federal Reserve is getting ready to decide the level of interest rates, and a rate cut of 25 basis points is already priced in. The cut is expected to continue the U.S. Central Bank's rate-slashing cycle, which kicked off at the previous meeting when officials axed 50 basis points from the borrowing costs. Now, I can tell you, at the time of this recording, the Federal Reserve did decide to cut by 25 basis points. So nothing out of the ordinary. It was priced into the markets, and it's to be expected. They would love to go gradual. They would love to take interest rates down from the 5.25 they were at to where they were at 4.75, down to 4.5, then 4.25. They have their dot plots, which are essentially projections for where they want and where they see interest rates going in the future. And this is right on course. Now, one key thing to note here is that DXY increasing. We saw this 2 years ago. The DXY increased to 112 in 2022. It increased to that level along with a huge stock market decline. As the stock market was setting in lows at the end of 2022, while the Federal Reserve was continuing along this path of tightening, of tight monetary policy, not continuously buying bonds as they do through QE. They were doing QT. The DXY continued to rise. And the reason why this is important is because they are correlated to a certain degree. A stronger dollar is good for some things, but by and large, the global economy does not like a strong dollar because a strong dollar means higher borrowing costs for other countries. Take Japan, for an example. Japan buys oil in dollars. Japan's currency is weakening. If their currency is getting weaker, while the U.S.'s currency is getting stronger, they are seeing a negative impact on both ends of the spectrum. Their currency is weaker, the U.S. is stronger. They have to take their weakening currency and buy a strengthening currency in order to get a vital resource that fuels their economy. That can be very difficult. And if you see that play out across the globe, to a certain degree, it could cripple things. You saw that in the 80s with the Plaza Accords when they decided to take the U.S. dollar down a peg. They weakened the U.S. dollar because it was hurting the global economy. Countries simply could not afford to pay for things using the reserve currency of the world, which the U.S. dollar still is. So it's something to note here. And wow, I thought this article was longer. But, I believe this is important to talk about because there's a lot of euphoria surrounding this Trump victory. The markets are going crazy. Bitcoin went up 10, 11, 12% on election night alone. Solana's up 15, 17% already. The stock market ripped 1,500 points. The Dow Jones, I believe, either that or the NASDAQ, ripped 1,500 points the day post-election, November 6th. There's a lot of euphoria, and I believe the euphoria is going to continue into the end of the year. But seeing the DXY increase isn't necessarily a good thing for risk assets. However, if you're playing this out long enough, I could see the DXY continuing to increase, as they say here in the article, because of the pro-America policies, the onshoring, the revitalization of America's workforce. That is going to make the dollar stronger. It's going to hurt some other areas of the economy. I could see the DXY continuing to increase. At a certain point, it may become unbearable for other economies, other countries. At that point, you see a weakening in the dollar because the Treasury is simply going to have to do it in order to salvage the bond market and in order to salvage the global economy at large. You're not going to have anybody to buy your debt, and you're not going to have an economy to sell things into or buy things from if people simply cannot get money circulating. When that happens, you could see another influx of QE. And that QE would send the dollar down, while it would also send risk assets to the moon. So if you think that this euphoria you're seeing in the markets right now and what may be coming is massive, I would consider that perhaps we haven't seen anything yet, and that over the next 4 years, you and I are probably going to see risk assets go to levels that will absolutely break your brain, which means that, of course, there are no certainties, just probabilities. But I know with my money, I want to be in the markets. Even if there is the potential for a giant downturn, a ridiculous correction, perhaps even a GFC type event, a great financial crisis type event, I want to be in the markets because there's going to simply be too much upside to ignore if this pans out the way I believe it does. And I think you're seeing the setup punch for that inevitable knockout of the dollar's value and of these resistance levels in risk assets. But yeah, this is going to be interesting to watch. This is going to be very interesting to watch because my, oh my, things are getting crazy. But with that being said, if you enjoyed this video, if you gained value out of it, subscribe to the channel, and I will see you in the next one. Much love, peace. This is Nathaniel Kanakal, and have a blessed day.